If a company suddenly closed its doors today, sold off every factory, desk, and server, and paid its debts, the cash left over is its net asset value, or NAV. But if you look at the stock market, you'll rarely find a company trading at that exact price. Shares almost always trade at a premium, well above this physical baseline. That discrepancy exists because NAV only counts things you can touch. It completely misses the internally generated variables that drive a business, like intellectual capital, brand reputation, and expert management teams. This creates a very specific problem for investors. How do you assign a concrete dollar amount to an invisible asset? Basic balance sheet arithmetic simply isn't equipped to do it. To bridge the gap between tangible assets and a company's actual market price without resorting to pure guesswork, investors have to rely on advanced equity valuation models. The first way to price that intangible premium is by looking through the lens of cash returns, mathematically valuing the direct payments a company makes to its shareholders. This page outlines the standard textbook mechanism used for this exact approach, the Borden growth model. The theory here is straightforward. The model determines a company's share price by taking its expected flow of future dividends and discounting those payments into infinity. But there is a major catch. To make the math work, the model has to assume that those future dividends will continue to grow at a constant, perpetual rate forever. This equation shows exactly how the moving parts interact. It requires three specific inputs: the expected dividend in 1 year's time, the required rate of return for the investor, and that assumed constant growth rate. While this effectively puts a price tag on what ends up in an investor's pocket, it has a massive blind spot. It is completely blind to the actual operational wealth being created inside the company's walls. To measure that internal corporate wealth creation, analysts use a different tool entirely: economic value added, or EVA. EVA operates on a very rigid threshold. Under this model, simply turning a profit at the end of the year isn't enough to prove true value has been created. Instead, a company must earn returns on its assets that mathematically exceed the weighted average cost of capital used to finance those assets. This chart shows how that value gap works. It is a binary outcome. If operating profit exceeds the cost of capital, value is actively created. If it falls short, value is being destroyed. There is a critical limitation to EVA. It only looks backward, evaluating a single historical accounting period. To forecast forward, analysts use market value added, or MVA. This metric represents the market's collective assessment of the present value of all a company's future EVAs combined. This creates an actionable trading signal. If an analyst projects that the present value of those future EVAs is greater than the current MVA, it indicates the stock is currently undervalued. Each of these mathematical approaches comes with built-in flaws. EVA strictly looks backward, MVA requires speculative forecasting, and Gordon growth relies on rigid, constant assumptions about the future. Because of these differing perspectives and inherent blind spots, no single formula gives you the whole picture. They have to be used collectively to properly verify an investment opportunity. Ultimately, the stock market acts as a forward-looking machine, constantly attempting to price future performance rather than just auditing physical balance sheets. True investor edge relies on using these strict mathematical models to calculate the invisible future wealth of a company.